It's a pleasure to be speaking with everyone. This has always been a very fun panel that I've enjoyed very much because we get a chance to talk about some of the more difficult issues that we encounter as valuers, particularly here in India. And while we have a few topics that we always like to talk about, such as cost of capital, financial instruments, contingent consideration, we're looking very much to answer questions from the audience. So I think we'll start with just a few rounds of comments from our panel, and then we very much invite questions from everyone, and we'll be happy to answer them to the best that we can. But I always like to start with talking about developing cost of capital. This has always been an interesting topic, especially in countries where we don't quite have the same data transparency that I benefit from in the United States. So Gagan, we spoke about this before. Can I ask you to start with a few comments about this?
Thanks, Ray, for the opportunity. Yes, we spoke on the topic in Mumbai last month. And being a developing market, there's a lot of challenge in evolving cost of capital calculations, not per se in Indian context, but in an Asian context also. Our experience has been that the information available on a public domain has been very restricted. So you need to use a lot of parallel corroborative evidences to substantiate and to build different models to make sure that you are arriving at a definitive range of cost of capital as required in a developing economy. And that has been the case, in many other, with many other valuers, friends who have been doing it across India. So the challenge primarily remains with respect to the information and how we extract and build models over the information available on record with us. So yeah.
And perhaps as a follow-up from a auditor, Big Four perspective, talking about the same thing, perhaps would you like to add a few comments on that?
No, what you said, and it's correct, because we always get challenged on what is the capital or the discount rates. They are the ones which always get challenged, and that's where each valuer's view can be different. While it's quite simple to get a risk-free rate or all those factors in, then what is the market expectation of return? How do you go about determining the risk-free rate also, especially in a scenario where suddenly the interest rates are moving up or down? So all those things come into play, and then obviously we always have issues around small stock premiums, what to apply, company-specific discounts, DLOM, and all those aspects when you're trying to do a valuation. And all these things are subjective at the end of it.
Okay, thank you. And perhaps, Kapil, would you like to add a few?
Yeah, I think Indian market, so when, the farmer fringe anomaly, which we talk about in terms of, discussing on, the cost of capital and the sort of premiums and discount which one needs to do, the Indian market maybe becomes a lot of apt example to apply a lot of those anomalies here. But said so, yes, there have been various, it's again a multi-factor model which is sort of gets built, because one is using CAPM, but there's a lot of industry analysis which companies do, which consulting firms do as to what the industry expectation is, and help us to drive out or to be closer to the ideal cost of capital, obviously depending as to what the sectoral expectation is. So if it is an FMCG, and how the FMCG industry players are looking at the cost of capital for them vis-a-vis maybe the real estate players who have a higher cost of debt and higher similar expectation in terms of cost of equity for them.
Okay, thank you. And Rajiv, would you like to perhaps add a few comments regarding your time as an expert witness and in arbitration?
Yes, the cost of capital is a big issue in terms of, especially you have to defend your work. Estimation and calculation is easier as long as you are doing. But if you have to defend your work, it becomes very difficult. So what are the broader methods available before us? I can classify into three. The first one is your look back method. That means the historical data you use it. The next one is you do an implied cost of capital, which is based on what way you predict the Sensex in future and you can calculate. So if I look at the Indian scenario, the two big challenge comes into this. Because in my understanding, the courts and etc., they do not accept anything which is too subjective. And if you say it is based on my experience and based on this and that, they will say then take it out. So that is very difficult to convince them. So quantitative or statistical support is what is very, very important. So if I have to go back, look back method is still, one can accept it because you have the data to prove that this is what has come. I'm not saying that it is, we have got a long series of data, we have a very small standard deviation, very small standard of errors, etc. These problems are there, but still you will have some quantitative data as compared to your subjective assessment. But the big issue comes out in India is most of the time this calculation of cost of equity, especially if you calculate beta, is done with the Sensex, which has got 30 stocks. Out of that, 4 or 5 stocks has got a huge weight. So it is a biased basically in terms of, it is not a meeting the definition of diversified portfolio. The most scientific index in India is the Nifty 50, so which has got the statistical stamping in terms of a fully diversification stage, and it has been a research paper was issued by Kellogg's in that terms, that after that if you add any number of shares into this Nifty 50, the further diversification of unsystematic risk is not possible. So therefore it is a most scientific one. You can develop based on that, and look back method is what it is defendable. But there is another important point. What could be legally valid, it may not be a good valuation also. So that is a very important point. One has to understand that what purpose you are doing exactly the valuation is, because sometimes the court's view would be simply that what is the proof you are providing, and if you are not providing, then there is a problem. So the first 3 component is not a problem. The problems comes out after that. What we do 2 more adjustments in terms of company specific risk premium, or what we call it as alpha, and then the next one is what we do a small company risk premium. In my understanding, this classification of risk is a big issue in India, internationally also, and a lot of time there is a overlapping, especially in terms of a small company risk premium and company specific risk premium. I have seen EY survey where they have said it is between 2 to 4%, but if you go in courtrooms and if they'll ask you what is the justification of these 2 and 4, from where you derive it, I mean, nobody will answer it. They say everybody does it, so it's like a cookie cutter, I'm using it. I mean, if you ask me, still it is subjective. There are some quantitative model, and of course some analysis you need to do it rather than simply going 1 or 2%. So I mentioned 2 methods. One was look back with this historical equity risk premium, which is a most acceptable across the globe. Then you have an implied method, mostly propagated by Damodar, and sometimes people follow it. But the biggest problem in India is you do not have a forecast available for a long period of time in public domain. So this also goes out. And the third one of late I've seen is what we call as a survey method. I mean, this is one of the most disastrous kind of thing, because even if you ask 150 CFO, oh, in your opinion, what is the cost of capital? I think it should be 15. It should be 14. So this, of course, has got no legal sanctity, and of course, it is not based on the principles of valuation. It's not meeting. So you probably get a situation where your work would be literally thrown out, especially in a high-profile valuation cases. So I would only say, when you are adjusting, make sure that all those aspects are taken into consideration before you conclude.
See, what Rajiv said, there are a couple of issues around that on the small stock and all that. Again, you need to analyze it, and you will be able to substantiate that courts abroad, even sometimes they are disregarding all these things. They say number of cases are there where they're saying that there should not be any small stock and all that. If you got your betas and everything right, then why are you putting in your additional factors. Whatever adjustments you wanted to do, you should do it onto the cash flows itself rather than trying to use a surrogate or try to adjust your or massage your value by adjusting your discount rates, because that's where your individual subjectivity or discretion is coming into play. So you have enough judgments of that in Delaware courts or any of the LCC or SEAC cases, but the challenge is all those things are not established in the Indian context right now. You may not have historical data around that or enough studies to justify what you are using. And trying to replicate a study which has been carried out in the US context and all that. Good, yes, we are moving up the learning curve fast, but whether it's really applicable or can it be applied? Because a small stock over here could be, in the US context, could be a large cap here.
Yes.
So, again, these are certain challenges which all of us face when we are trying to do this thing. And that's while Rajiv did say, trying to use a survey and all that, it's a disaster. But it also tends to give you a kind of a sense check that you're not falling apart, that your analysis is not totally wrong, and you are taking into account what the market expectation is. If you're not, and I say that over here, you should perhaps broad base your sample. That's what at least we do, is rather than sticking on only to the industry guys. Yes, take the investors also into account, the mutual funds, private equity and all that, and then factor in all their expectation into your survey. So long as your paperwork then at the back of it is there that I spoke to these 150 guys and I got this data, I can very well, support myself or go back it up with this thing. But like I said, it is not that one solution fits all.
Wonderful comments. This is always a great topic to talk about. But another topic that I encounter quite a bit in the US, which I'm certain happens here as well, is always reconciling management projections and defending them, if you will, as well as forward-looking statements. So perhaps we can go right down the line here and get a few comments on this one. This is always a good topic.
You want to start and then go there? Okay. Well, the base data has to come from the management at the end of it, because they are the guys who are running the business. Now the question is acceptability of that data, or I as a valuer, when I'm using that data, am I applying my mind to that data or not? Or am I blindly accepting what has been given to me? And that is where I think us as valuers, we need to be very cautious of, and we should really take that into account. Suppose I have a company which in a particular industry is not growing at all, but in India we are all optimistic, right? We always end up getting hockey stick projections. And future is always good. So we all know that. So we need to factor all these aspects in when we are trying to carry out the valuation. Just writing out that we're not doing anything, but we're just using the management projection blindly. Yes, you may use the projection blindly, but justify it perhaps in your discount rate what adjustments you're doing.
So agreed, so some of these management, so as a valuer, our role is not to, do management or do business projections, but to vet what the management has given. So we have to vet. The challenge, however, in the Indian context, in some of the late cases under insolvency, bankruptcy code is, and when you are, the valuer is required to also do a fair valuation of these companies. And now, these companies are obviously under insolvency, are stressed companies. And, what sort of projection do you really build upon those? And the sort of numbers which come. The management also is a lot of times is very reluctant in terms of giving projection, because we are obviously it is down and down and down, so what is left is basically the asset value for me. So yes, there have been iterations, we have been advising, so one has to look at a context, and for a management to build a base case where there is a sufficient capital infusion into the company, And then the performance, how does the performance of the company and how does the cash flow projection for the company happen, assuming a scenario where there is a capital infusion which is happening. So a lot of time we are also required to educate the management as to, what sort of, especially in some of these scenarios. But yes, broadly, when the going is good, as Ryan said, these are, the projections sometimes are very, very optimistic, which, or a hockey stick sort of a projection, which is the role of a valuer to look into it and, take a fair position on those projections.
See, our experience has been that the management, Indian, corporate management is always optimistic. As we all talk about optimism here. The second challenge comes is that the staff or the team that prepares the forecast is not aware that how the forecast has to be prepared basically. That is the basic, gap between what is asked and what is being given to us. And we as valuers have our own, ethical and moral duty to at least look at those numbers with vis-a-vis the sector in which they operate, screen it out and, filter it into proper matching numbers along with the industry to some extent, so that it does not give an aberration out of the industry or, it's way different than the industry is working. There has to be some reasoning along with it, proper, basis why I'm working different with the industry. So there are a lot of basics which is not right generally with the corporates when it comes to us in terms of the forecast or the projections. So it is the, special duty of a valuer to safeguard, as Vijay is also saying that, to attain that defendable position in the court of law, you have to, back your workings starting from the inputs given by the management. We can't get saved that, okay, this is given by the management and we have just taken blindfolded. It will fall on our face always, because whatever data, information, technology, methodology we are using to arrive at valuation, everything becomes part of our deliverables. So starting from the information being fetched from the management, we need to screen it horizontally, vertically, wherever it is possible and deep down to arrive at a logical and practical, output and then proceed with it. So I think this is the precaution that one has to go about it. But this will remain as a challenge as we speak.
So I will cover this in two ways. First is what is the legal position as far as the standard is concerned. So if I refer IBSC, it is the most acceptable standard as of today in the whole across globe. They have specifically mentioned that all management projections need to be investigated. That's the word they have said. Forget about validation. So, of course, the Institute of Chartered Accountants of India will come out their own standards, which is a complete diluted version of this. Why it is necessary, I'll tell you. A valuer to do a business valuation has to first understand business. If you don't understand business, then whatever number management will give you, accept it. Then it is not a valuation, then it is a calculation. Then you cannot express opinion over that. One of the court cases I am handling, the judges asked that where the 2 years projections are given for working capital loan in India. So whether the bank managers looks into the number or they simply accept whatever you give. It is a different matter where you do some adjustments, etc. But on a normal case, do they look into the number or not? The expert was asked this question. He said yes. So then they asked the next question, then what you did? Here you are doing projections for 5 years, accepting for all terminal value. So there was no role involved into this. Earlier, I remember when I had to take this issue that the valuer, in fact, most of the cases, the valuers writes in the limitation. Or as a part of assumption that the whole projections has come in from the management. What he is saying is a very important point. Who prepared the projection is most important. What is the expertise of the person who's prepared the projections? Whether he has some understanding of the strategic part of the company, or whether he is preparing a routine 1 or 2 year working capital projection. And also for evaluation, he has been given for a projection thing. If you have to do, suppose, for an impairment projection, which should not cover the synergistic thing available to a specific buyer, which generally is a case in case of M&A. So it has to come a different projection for the same purpose. So what is the experience of a person who's preparing these are all risk. And out of that, a valuer when is starting, he has to investigate right. Of course, it helps us if it is coming a certified projection from the management. But that is the first part. The second part is start that whether the validation required or not, the answer is yes, it required. If you are not doing, then of course you are not doing the proper valuation. Then how do you do that is a different matter. What are the evidence available to do? The next question would then come, if I differ, what is the way I should do it? Suppose tomorrow management says in India, oh my God, this board has approved, I will not change it. A number of cases I have come across this, this is a sacrosanct projection, it can't be changed, it is approved by the board. But that was for your business purpose. If I find something which is not something acceptable based on the numbers available in the market, whether it is a growth number, whether it is your margin numbers, whatever, I mean, there is in psychology, you see, there is a confirmation bias. Most of the time, projections preparer, depending upon the purpose, they will always take only positive information, they exclude all negative information. And they believe that they just close their eyes, that I'm not looking into the negative. There is always sunny days, there is no rainy days. That kind of a projection comes in. I mean, if you accept that, probably that is the thing which is going to be questioned. So, 2017 IBS standard before and after is a whole lot of change in terms of the projections. So I think Indian courts, if I have to look at the past case laws, do not look into those case laws because those case laws were a situation where it was not fully argued. Also, I would say that all case laws for M&A purpose, the courts generally do not go into too much detail. In fact, in past they were not concerned at all because they believe if majority shareholders agreed, everybody else agreed, one or two minority shareholders are objecting. So unless something very important, I will not look into this. In case of Cadbury, judges said that the error should be such that while running I should read. The error should be such that while running I should read, that is the error I am going to accept. So, but that is not the case for a valuation. If it goes in NCLT, now the cross-examination will happen. Earlier it was not happening, and there's a lot of activism. People have come who are into this process. This is going to be a big challengeable area. So if somebody is accepting without looking to numbers, sometimes your narratives and the numbers are totally on the face of it. If you look into, they are not, correlating, and that is a disaster. If it is coming from somebody who's prepared, we have not applied our mind, accepted it, and therefore it is giving a proper way of looking into the situation. I don't think so. So you will have a big trouble. In fact, if NCLT, which is looking right now, in my understanding, as of today, there is no cross-examination happened, but it is provision is there. So the valuer will be called, and there will be a cross-examination. So and don't forget, this is not High Court, because there will be a specialized people sitting there. So it could be a different scenario, because in High Courts it was, for them it was a not something material thing. Now for them it is a specialized thing. So the NCLT in India is like you have a deliver courts where all experts sitting. So here is specialized commercial courts where people would look into this kind of practices, which was wrongly done in India most of the time. That's what my comment is. Last point I would like to add, at the time of taking projections, one should be very careful what kind of a risk has been addressed in the projection and what kind of a risk has been ignored. So the risk which has been ignored in the projection has to be captured through the discount rate. And there is one very simple conceptual point is this, that the two-way risk, what we call is a systematic risk, should always be, I repeat, this should always be addressed through the cash flow. It should not be addressed through the discount rate, because it will always going to give you a result in a compounding manner, which is not the case. The two-way risk can go in your favor and it can go against you also. And the one-way risk, that is your systematic risk, is the one we should address in the discount rate. So if I have already addressed there, I should not address here. Most of the time you will see only one projections coming up. I asked I'm not naming the company, there's a very large listed company. I said, this is your projections. What kind of a scenario you assume for preparing this projection? Is the best case, is the worst case, what kind of a case is it? This is the projection. You assume whatever you want to assume, that is my projection. So therefore, the discounted cash flow method is a discounting of expected cash flow. Expected cash flow is not the meat cash flow or the management thought of cash flow. It is basically probability weighted cash flow. So if I have addressed some risk and still, I think somebody was, even most of the cases you will see this is prevalent in India, where people try to factor in the discount rate, illiquidity discount, through the discount rate. This is defying all economic principles of valuation. So, I mean, unless we understood the risk and the business and the narratives which is, given in the report, we will never be able to understand the numbers, and that number validation exercise is very important for the valuer when you come out. So, you have to demonstrate that what exactly you have done in terms of that kind of analysis for projections.
Thank you for that. I have one more question for the panel, then I'd like to start getting some questions for the audience, so start thinking about what you'd like to ask. But the last one I would like to address is on contingent consideration. Would anyone like to start that conversation?
Yeah, so, the evolving transaction structures, and we touched briefly on the M&A session as well, is when you see a lot of, contingent consideration built onto the deal. So while the first tranche of money to the target company, whether it be an strategic acquirer or a private equity fund, they might build out certain earn-out model. The subsequent tranches, while the first tranche gets an X percentage into the company, but the subsequent tranches are fixed based on the the EBITDA or the revenue multiples or revenue numbers which the company are able to achieve. Now, from a valuation perspective, because how do you treat those probabilities? So whether it is part of the acquisition cost or it is part of the compensation cost to be counted for in the second year or a third year domain is also becoming more and more important. There have been various methods which have got applied. So it is like an option, real option model, which sort of built in based on probabilities, which is being looked at. But the general principle currently has been in terms of having the probability assigned and is becoming a part of an acquisition cost today for the company.
See, it depends on the deal to deal, what kind of deal is it, and it has been dealt with accordingly. But as Kapil said that in M&A transaction, it becomes very evident part to understand it deeply and then dissect it into parts that where it needs to be absorbed, which side of the table and who is bearing that cost. But contingent liabilities are to be seen in a very different note. Again, depends upon what purpose of valuation you are doing it. So it is very relevant from that point of angle.
So if we are looking for contingent consideration, on a lighter note, I was just referring Business Valuation Resources. They have come out with a book, and they said that if you are doing valuation and it is to be audited by Big Four, then this method. If you are doing valuation and if it is not audited by Big Four, then any method. So, it is very interesting that they have mentioned this in this report. So, if I have to refer, we have a Monte Carlo simulation for capturing contingent consideration. I remember in India, one case I used a probability weighted method, which is equally acceptable. And scientifically it is as good as Monte Carlo. It can go that bad and this can go bad. Monte Carlo simulation only does it in thousands of scenarios, lakhs of scenarios. Here we have a few scenarios. If you have a good few scenarios created with a weighting and expectation of management, that will be much better as compared to thousands of scenarios. But sometimes people are so mechanical. Again, I'm coming back to this quantitative part. And an auditor, if you have heard only one thing that we do this, so I want this only, I have only in this, there is a comfort, and I will not accept anything else. Is there any logic for this? There is no logic for this because it is being accepted. So you have a probability weighted method as well as you have a contingent consideration valuation goes for your, in case of M&A space, you can use Monte Carlo or you can use real option in some of the cases because the visibility would be very difficult to do that. But there is one important aspect, especially for the new accounting standards in India, is the valuation of corporate guarantee. There is what is happening is a big issue, because most of the time people are using interest differential method for, and some of the, I mean, I would say it's a bizarre kind of situation where people are using the guarantee commissions. I mean, this is not the correct way of looking into this, because in the most of the cases, those subsidiaries who have got the guarantees from the parent would not have got the loan from the bank if there was no guarantee, which effectively means interest differential method cannot be used at all. And this is a contingent consideration. This is a contingent option, in fact. So there should be an option method of valuation should be used rather than interest differential or using a proxy of bank guarantee commission. This is the last, but was the most, I would say, the least reliable kind of a situation. So two issues in this part is the premium part of how much you are getting and the methodology, which I discussed. But again, I mean, you need to consider what are the inputs available, details available, and of course, where you are going to get scrutinized. In fact, now I would say you would be scrutinized anywhere. It's not only the auditor with a new registered value rule coming up. You maybe your 10 years down the line, your case will be open up, and you never know that after retirement also will be attending courts all the day. So that is going to be a big issue, because the banks, let me tell you, there's going to be a serious issue of valuation in case of banks when the moment they moves or they follow the index, because that is the reason why 1 year delay has already has been decided, and I personally believe that it will be delayed for by 2 more years, because if they adopt the index next year, 20 plus public sector banks net worth will be negative. So around 13, 14 are already under PCA. Most of them would be, they will never come out of this situation because this NCLT is creating a damaging impact in terms of the realization. The average realization is not even 30-40%, which effectively means this will be factored in a concept called AZD, that is a loss given default, where these numbers will be factored in terms of for future forecasting of your provisioning. And that is going to create a big, big trouble. And this is a historical data set. You can't avoid it. So that's what.
Thank you. Thank you for that. I would like to get some questions for the audience. This is your chance to ask our panel if you have something that sounds of interest. Please wait for a microphone, if we can get a microphone so the audience can hear, right in the center.
Just a question for the panel regarding the new DT guidelines on only merchant bankers being allowed to do the valuations using the DCF model. I just want to know your views. How do you think it will affect the startup side? Thank you.
Well, there's a flux right now, okay? They've changed the guidelines suddenly. I think they are talking about, there is some representation which has been made, and this we've heard again. Honestly, I think there is going to be some very big issues around that if you're going to be restricting it, because one, what you're doing is you're bringing in place inconsistency, because for certain laws you can have one guy doing the valuation, for another guy, this person is not eligible. One is that. Second is there could be logistics issues, because a merchant banker may or may not be present all over the country. Thirdly, there will be cost implications, and someone is somewhere and he needs to identify a merchant bank to get that thing done. Fourthly, and I think that is again going to come up somewhere, is while for so-called people who are, say, CAs, CS, ICMA or any other place, you still got a regulator in certain way. There is a disciplinary mechanism which is there. Now, I don't know, because merchant bankers can also be going into various categories and qualities, right? How are you, who's going to be their regulator? SEBI? The individual concerned over there may stop doing that work. So I think, but like I said in the morning itself, it's one step at a time. We are moving forward towards it. Things are going to evolve over the next 1 or 2 years. Who thought when the insolvency law came in 1.5 years back, that you will be at where you are today. So similarly, perhaps for a registered valuer also, and I look at it like insolvency will take another perhaps year and a half, 2 years for things to stabilize over here. Over here also, it's a journey on which we embarked. Things should move forward.
So I would like to point here is that, you know, it's a change in regulation. So we are all sitting in a time where we are transforming era, you know, IBBI has come, Companies Act has, you know, modified. Similarly, you know, the other acts have to walk in tandem. So somewhere or the other, they are moving into more tighter regulatory environment. So as a Cat 1 merchant banker has got more responsibility, more, you know, towards not only the regulator, which is SEBI, but they are accountable for more different things to the public at large. So that is, you know, case in point.
I think I saw another hand. Okay, over here, please.
Normal due diligence. But for the projection, there should be a technical due diligence also. Product, process, price, and many other things are there, including the technical due diligence of the assets. What is the class of assets and whether that asset is going to have the impact ultimately to the projections or not. So there should be two types. Like in the valuer today, there are technical valuers and there is a financial valuers. So similarly here in the projections also, we should have the two sets of due diligence. One is technical and another is a financial. That is a small observation in this situation which I want to convey. Thank you.
I think you have rightly raised the issue. In my understanding, this will be next 10 years, this is going to happen because in courts, projections, they classify into segments, especially in Singapore arbitration. They classify into two segments, one is a financial guy, another is a technical guy. So that fellow comes for witnessing, then he will only answer on the technical part of that. The other guys will convert those technical part into the numbers. But that valuer cannot be expected to be an expert on technical side. He will rely on to this, what has been provided by the management, because that is would be too much asking from a valuer.
Anything is there, you have to technically view what is the reality of the product, service or other implications. So then that should be the corroboration by finance that this should be appropriate rate or not. And then you derive the value. So ultimately it's a very simple invoice is there, whether the quality of the quantity is correct or not.
No,
and then
no.
you are relating to the
Sir, I think,
rates and then you relate to the values. Thank
Sir,
you.
I can give you one small example, probably will clarify your situation. In all bank loans, there is something called TEB. And what is happening after this? This is another scam in this country. Correct. And these guys have been totally, you know, they have been, nobody is talking about them. I am on the board of Union Bank of India. I know how much of cases I have identified in TEB study. You see the numbers and you can tell up front that this is wrong, just by looking to the number. And they have done the TEB study and nobody is talking to them. After that, the other people will come in. So that is not a solution. There is a hell amount of responsibility on the management itself. It is their responsibility to first certify those, take those technical input. Valuer can go through, use a common sense into this, but ultimately they'll have to see the financial numbers. I think, what is your, US also happens the same way?
I think that is the same. I agree. I think I saw one more hand over here. We have time for one more question. Please wait for the microphone. Right behind you.
I have a question on VAC. In case where the parent company is operating in a different country and the subsidiary company is also operating in a different country, and we are valuing the company on a consolidated basis. So in this case, while calculating the VAC, which country risk-free we will consider and the risk premium?
So as I hear you, what you're saying is you're trying to value a company which has got various subsidiaries across various countries, and how do you value it, right? I can talk about PwC or whatever. The way we do it is when we are valuing each subsidiary in a particular location and we are allocating value, then we will take a look at the data relevant to that location. However, if I don't have the data with respect to each subsidiary, I'm not valuing, and I'm valuing the entity in totality perhaps. I'm not getting into each individual country specific. Then I will look at the country from where it is operating and where it's headquartered, working out the cost of equity or cost of capital or the WACC for that country, and then try to use it rather than then try to break it up, because it happens a lot of times when someone in the USA and it's got 20 subsidiaries or 150 subsidiaries across the globe. They may not give you each country-wise data.
Yeah.
They will say, look, this is the growth rate which we've got, we will get it from all these countries or whatever, this is what we have. So then someone will perhaps use only the, but what you got to keep in mind is the data which is coming, hopefully or rightfully, that has to be in the currency of that country to which you're applying the WACC also. Otherwise, you could get lost that if you're using data in US terms and try to apply a WACC based on INR, you could go wrong.
Sir, but we are valuing the company on a consolidated basis, and so how do we capture the systematic risk?
No, like I said, if you're allocating value across geographies,
Yes.
across each country, suppose you're allocating the value of a US parent who's there, of its subsidiary in India,
Yeah.
then only if you're trying to determine the value of the Indian entity, you will use cost of capital and other factors which are relevant to India. However, if you're valuing it at the US level, you would use the data on a consolidated basis over there, because over there when you will be using peers also, they will be of same kind, who will have subsidiaries and everything floating all over the world.
Okay, sir. Thank you, sir. Sir, I have one more question. That while calculating the WACC, we used to take the debt equity ratio. Which debt equity ratio we have to consider? Either it is based on the industry, or it is based on the subject company, or it should be a stable debt equity ratio.
See, as sir said that if the companies are in individual countries,
No, sir, I am not saying about the first question. This is the second question. When we are going to calculate the WACC for the entity, so which debt equity ratio we should have to consider, which that is the subject company debt equity ratio, or the industry debt equity ratio, or stable debt equity ratio,
so you have to analyze.
while we relevering the beta for the subject company.
You have to analyze 2-3 things in tandem. One is what is the industry debt equity rate.
Yes, sir.
Second, what is the maturity stage of your company in that industry.
Yeah.
Third, what has been the track record of your company vis-a-vis their projected debt equity. So all these three are critical factors in determining your optimal debt equity ratio.
Okay. So, sir, what would be the basis for that?
See, again, this is more, there's no one right answer to everything. It's more judgmental, and you have to see things, right? You know, what results are coming out of these three scenarios.
Okay. Thank you, sir.
Okay, one last question, same table, please.
I want to ask whether whether for discount or lack of marketability is to be applied for DCF valuation methodology or not.
In theory, yes, you do need to apply it if you're talking about a unlisted company. There is DLOM, or as what we call as discount for lack of marketability.
Okay, thank you.
Okay, with that, we have enjoyed this very much. Great questions, thank you. It's been our pleasure to answer. So, behalf of the panel, we thank you for your time.